Jim Rickards claims he's found stocks with 200x upside. I reveal them in this video so you don't have to pay $5,000 for them. There's multiple stocks to uncover, so we'll just jump into things. This presentation is about Trump opening federal lands for mining and the companies that will benefit from that. Here's a screenshot for the clues for the first stock, which Rickards claims has institutional ownership of only 8%, has a track record going back nearly 45 years, including mapped legendary Eagle Ford and Bakken Shale, have 111 patents, so their services are pivotal and in demand even outside the resource space. Additionally, Rickard says they've worked with the DoD, DOE, and President Trump in the past, and that the Department of Homeland Security contracted with them to deploy MDP sensors to identify underground tunnels at the US/Mexico border. And then Rickard says they manufacture their own equipment in America, and they've focused more on broadening their offerings to include mining surveys, while their competitors have mostly focused on oil and gas. And this company has a market cap around $74 million, with total revenue of $116 million last year. This is Geospace Technologies, ticker GEOS. Here's what to know about this stock. Geospace Technologies Corporation is innovating seismic technology across the energy, water, and industrial sectors. In energy, the company develops advanced land nodes and its Mariner ocean bottom systems for hydrocarbon exploration and reservoir monitoring. Its smart water division supports nationwide municipal utility modernization through Hydrocon connector cables. In the industrial segment, Geospace offers security products and imaging equipment, including its Geovox heartbeat detector technology. Together, these initiatives reflect an aggressive diversification strategy that reduces the company's reliance on cyclical energy markets. Geospace faced a challenging year marked by energy sector headwinds, though growth in its smart water segment provided a strong offset. Total revenue came in at $110.8 million, an 18% decline year over year, while the company reported a net loss of $9.7 million compared to $6.6 million the prior year, resulting in diluted EPS of negative 0.76. Geospace ended the period with a solid cash position of $26.3 million and an additional $8 million in available credit, supported by minimal debt of just $0.97 million. Smart water revenue rose 10% to $35.8 million, its fourth straight year of double-digit growth, while energy revenue fell 35% to $50.7 million due to reduced offshore exploration and lower rental utilization. Industrial revenue declined 4% to $24.0 million, primarily reflecting the completion of a large government contract. The bull case for Geospace centers on several strategic advantages that position the company for long-term resilience. Its proven diversification is a major strength, with smart water now accounting for roughly one-third of total revenue and providing a steady, non-cyclical income stream insulated from energy market volatility. Recent major contract wins, including a large permanent reservoir monitoring award from Petrobras and a significant pioneer node sale to Dawson Geophysical, underscore the company's technology leadership. Geospace also maintains a financial fortress with more than $26 million in cash, minimal debt, and $64 million in working capital, giving it ample liquidity to endure industry downturns without solvency concerns. Meanwhile, its innovation pipeline, highlighted by the Aqualink IoT water monitoring platform and the August 2025 acquisition of Geovox Security Technologies, opens new addressable markets in smart cities and border security. The bear case for Geospace highlights persistent headwinds that continue to challenge profitability and weigh on investor confidence. Despite its diversification strategy, the company remains heavily exposed to energy markets, with a 35% revenue decline in energy solutions, underscoring its vulnerability to oil exploration cycles. Geospace also faces a profitability crisis, posting nearly a $10 million net loss in FY25 and offering no near-term earnings or dividends until it can return to break-even. Market sentiment has reflected this pressure as the stock dropped more than 17% following the November 2025 earnings release due to widening losses and missed revenue expectations. Operational inefficiencies, including higher manufacturing costs and ramp-up challenges for new products, are further compressing gross margins. The key question for investors is whether smart water growth and upcoming product launches can scale quickly enough to counter prolonged weakness in the energy sector and pull the company back to profitability. Overall, Geospace Technologies is a turnaround in progress story. It is successfully pivoting from a pure-play oil services company to a diversified industrial tech firm. However, the legacy energy business is currently acting as an anchor on growth. It may be an interesting watch for aggressive investors who believe in the smart water growth story and a rebound in offshore exploration, but conservative investors may want to wait for proof of consistent profitability. Here's a screenshot for the second stock, which is called the Wildcat. According to Rickards, this one will profit from a less followed executive order which focuses on deep-sea mining and extracting $100 trillion of underwater minerals. Rickards says they are the company with proven deep-sea mapping capability, having successfully mapped hundreds of thousands of square miles across Africa, Norway, and the Gulf of America. They apparently have something called a deep-sea pathfinder project, using autonomous robots underwater to map the ocean floor, and that these patented autonomous underwater mineral locators can be dropped in the water and then retrieved a month later, with perfect maps. This is TGS and can be bought over the counter with the symbol TGSGY. TGS has evolved from an asset-light seismic data specialist into a fully integrated energy data leader following its transformative merger with PGS. Historically, the company operated a low-risk model built around its multi-client data library and high-margin licensing business. The integration of PGS fundamentally changed this structure, creating a vertically integrated powerhouse that combines a modern seismic vessel fleet with TGS's extensive data assets to deliver true end-to-end capabilities. Today, the company operates across four major segments: multi-client, which remains the core profit engine by licensing seismic data to multiple E&P customers; contract acquisition, which uses the vessel fleet for client-commissioned surveys; imaging, where advanced processing converts raw seismic input into high-value subsurface intelligence; and new energy solutions, a small but strategically important business focused on CCS and offshore wind datasets. TGS's Q3 2025 results, the first full quarter following the PGS merger, show a clear rebound in operational performance and early proof of integration benefits. Revenue reached $388 million, up 26% sequentially on the strength of multi-client licensing activity, while EBITDA climbed to $242 million, representing a 62% margin as merger synergies continued to enhance profitability. EBIT improved to $105 million, or a 27% margin, marking a solid return to operating strength. Free cash flow came in at $81 million, fully covering the dividend and enabling faster debt reduction. The company reinforced its capital discipline by lowering 2025 capex guidance to $110 million from $135 million, and reducing net debt to $432 million from $479 million in the prior quarter, all while maintaining a 0.155 per share dividend that supports a 7 to 8% annual yield. The strategic focus now centers on maximizing free cash flow and accelerating deleveraging without compromising shareholder returns. The bull case for TGS centers on its scale, margins, and free cash flow strength, all of which have been materially amplified by the PGS merger. The combined company now operates one of the world's largest seismic vessel fleets and multi-client data libraries, giving it enhanced pricing power, broader global coverage, and a durable competitive moat built on fully integrated acquisition to imaging capabilities. Margin performance is exceptional, with cost synergies helping drive EBITDA margins above 60%, best in class for the seismic industry, while rapid integration and operating leverage continue to unlock efficiency gains. The multi-client library remains a highly attractive counter-cyclical revenue engine, producing recurring cash flow at minimal incremental cost, as the same datasets are licensed repeatedly, providing resilience even when E&P spending cycles soften. This financial strength supports compelling shareholder returns anchored by a 7 to 8% dividend yield, backed by consistent free cash flow generation and a capital allocation strategy that balances debt reduction with reliable distributions. The bear case for TGS centers on its exposure to industry cyclicality, higher leverage, and uncertainty tied to the long-term energy transition. The company remains heavily dependent on oil and gas exploration budgets, which fluctuate sharply with commodity prices and provide limited visibility beyond a 12-month horizon. The merger with PGS also shifts TGS from an asset-light model to a more asset-intensive structure, introducing fixed costs, vessel utilization risk, greater operational complexity, and ongoing maintenance and dry dock expenses. Post-merger leverage is elevated, with net debt at $432 million, constraining strategic flexibility and requiring that free cash flow be directed toward deleveraging rather than growth initiatives, while covenant compliance could become a concern if EBITDA weakens. Layered on top of this is the broader uncertainty of the energy transition. Long-term hydrocarbon exploration demand is unclear. Traditional E&P spending faces secular pressure, and the company's new energy solutions segment still contributes less than 5% of revenue, leaving TGS with an unproven pathway to pivot meaningfully. While the business offers strong current income and operational scale, investors must weigh these risks carefully against its cash generation capabilities and market leadership. TGS-GY is currently a value and income play. It is essentially a bet that the world will continue to need oil and gas exploration data for the next decade. If oil prices remain stable, TGS's post-merger dominance and cost-cutting should generate massive cash flows, supporting its high dividend. However, the added weight of owning vessels makes it a riskier hold during oil market downturns compared to its past asset-light self. Here's the info we get for the third stock. Rickards calls the third company the innovator, and says that this company sells the technology the industry uses, with the implication that all companies in the seismic data space need this particular company's technology. He says they provide AI software that makes modern mineral detection possible, and that all the companies he talked about above need this technology and their proprietary AI algorithms. So every major MDP company uses their software, and as a software provider, they have infinite scalability. And he says this company has a market cap of $54 million, with approximately $46 million in annual revenue, but could reach $2 billion in revenue over the next 12 months. So it's got 4,340% gain potential. This is Mind Technology, ticker MIND. Mind Technology is a specialized marine equipment provider focused on seismic survey systems, hydrographic mapping tools, and defense-grade maritime sensors, primarily delivered through its core CMAP division. Its products support seismic exploration by supplying oil and gas companies with subsea mapping equipment, enable hydrographic survey teams with high-precision tools for offshore construction and infrastructure work, and serve defense customers through anti-submarine warfare and maritime surveillance systems. The company also supports marine research by providing scientific instruments for oceanographic data collection. While project-based hardware sales historically drove performance, its revenue mix has shifted meaningfully. Aftermarket services, including repairs, parts, and equipment rentals, now account for roughly 68% of revenue in the first half of fiscal year 2026, giving the business a much more stable and recurring income base. Mind Technology's FY 2026 Q2 results for the quarter ended July 31st, 2025, show a business returning to sustained profitability, with revenue climbing to $13.6 million, up 36% year over year, thanks to delayed Q1 shipments and strong aftermarket demand. Net income improved to $1.9 million from $798,000 a year earlier, marking its first meaningful stretch of profitability after an extended period of losses. Gross margin held near 50%, supported by the company's high-margin service and aftermarket revenue streams. The balance sheet remains clean and low risk, with $7.8 million in cash, no liquidity issues, and zero debt, removing any refinancing pressure. All preferred stock has been converted to common shares, freeing cash flow for equity holders going forward. The key concern is backlog deterioration. Current backlog stands at $12.8 million, down sharply from $21.1 million in April and $26.2 million a year ago. While Q2 performance benefited from fulfilling older orders, the decline in new commitments suggests potential revenue pressure in early 2026 if fresh contracts fail to materialize. Mind Technology's bull case centers on a strengthened financial and operational foundation that positions the company for durable, higher quality growth. Its fortress balance sheet, zero debt paired with $7.8 million in cash, eliminates solvency concerns and gives the company room to pursue tuck-in acquisitions or counter-cyclical investments. The business has also evolved into a recurring revenue model, with roughly 68% of sales now coming from aftermarket services such as repairs, spare parts, and equipment rentals. These high-margin streams create customer lock-in and stabilize earnings even when hardware sales fluctuate. Importantly, Mind has reached a profitability inflection point. Sustained positive net income and adjusted EBITDA confirm that its operating model now works at scale after years of losses. Layered on top of this are favorable macro trends, energy security initiatives, offshore wind development, and expanding subsea infrastructure, all of which support long-term demand for marine survey and sensing technologies. In short, the shift toward recurring aftermarket revenue meaningfully de-risks the company's earnings profile while preserving upside from cyclical hardware opportunities. Mind Technology still faces several meaningful risks that temper its turnaround narrative, the most pressing being a sharp backlog decline, now $12.8 million versus $26.2 million a year ago. Q2 strength was driven by shipping older orders, but weak new bookings raised the possibility of a revenue air pocket in early 2026 if contracts don't rebound. Revenue also remains lumpy, as hardware-driven project sales can swing sharply from quarter to quarter. Even a single delayed contract can materially distort results despite the growing stability of aftermarket services. As a microcap, Mind carries liquidity risk as well. Its thin public float amplifies volatility, and trading flows can be driven more by institutional positioning than fundamental performance. Customer concentration adds another layer of vulnerability, with much of its marine seismic revenue tied to a small number of energy majors and survey contractors, making demand highly cyclical. Overall, Mind is a high-risk, high-volatility turnaround story, one with improving underlying economics, but still heavily dependent on successful backlog replenishment to sustain momentum. This stock, like the others, is too risky for me to jump in right now. If you like Mind, I'd wait for the order backlog to start building again, because if it doesn't, the earnings reports won't be good. And before you leave, make sure to click the link in the description for my free report on the top 10 stocks to buy and hold. These are companies I think you can buy and not worry about for a decade.